Chapters 7, 8, and 9, Lecture, Part 2. Let's get into receivables. Remember, receivables is when you are expecting to receive something in the future. Classes of receivables, the account that we've been using frequently is accounts receivables. That deals with customers, and when you sell something on account means accounts payable or accounts receivables. When it's accounts receivables, you expect to receive money in the future. The next two receivables are notes receivables and interest receivables. This is when you lend out money and you expect to be paid back in the future under notes receivables. And when you lend someone money, you want to charge them interest. And so not only do you expect the original amount back, but you also expect the interest, or you expect to earn interest off the money that you're lending. So that is interest receivables. This chapter focuses on accounts receivables and when accounts or customer accounts become uncollectible. In other words, you sell something on account and the customers in the future cannot pay you. So you cannot collect on receivables. There's two methods for accounting for uncollectible receivables. Again, remember this deals with customers. So two methods to record uncollectible receivables. And more specifically, accounts receivables. The reason why we want to record the uncollectible receivable is because we do not want the open account or the account that we expect or we were originally expecting to receive money from to stay open. So we have to write off the uncollectible receivable. So again, there are two methods to do this. The first way is called the direct write-off method. Some facts about the direct write-off method. In this method, you wait, or the company waits to write off an account. So whenever they think that an account is uncollectible, that's the time that they write off the account. That causes some problems because it violates an important principle in accounting called the matching principle. The matching principle matches revenues and the related expense in the same period. To illustrate, I've created a timeline here. At the beginning of the timeline is January, and shortly after January, we made a sale to a customer named Sean Carter. So a sale to a customer named Sean Carter. Let's say the amount is for $30,000. And in the future, we determined, or far into the future, we determined that we cannot collect from this customer. So here's a future date. Now we have to write off their account because we don't want their open accounts receivable remaining on our account. So we're going to write off Sean Carter's account for $30,000. Again, I got to emphasize that you made the sale shortly after January, and then far into the future, it's been determined that his account can't be collected, or the money that he owes, $30,000, cannot be collected. So now we have to write off his account. And this happens at a future date, far into the future. What you want to do here is when you write off this account is you want to debit bad debt expense for $30,000, and you want to credit the accounts receivables for Sean Carter. You're crediting this so his account will be cleared and will be written off. So $30,000. And there it is. You just wrote off his account, and if we look at our accounts receivable subsidiary ledger, we would look at Sean Carter and he would owe us, or we would expect to receive nothing from him because his accounts receivable would be at zero. The second method to accounting for uncollectible accounts is called the allowance method. So make no mistake, when a company chooses a method, they're going to choose one or the other, direct write-off method or allowance method. The allowance method, some facts about it. It makes an estimate of bad debt expense at the beginning of the period or before the start of the new period. So it makes an estimate of bad debt before really it's determined that a customer will not pay. This is important to note because you're recording the bad debt expense right away, even when you don't know which customers are not going to pay you. This is a good thing, the allowance method, because it creates an estimate of the bad debt and is recorded before, again, I'm going to emphasize, before you know which customers will not pay you. This estimate is recorded in this account called the allowance for doubtful accounts. The allowance for doubtful accounts is a contra asset, meaning its normal balance is a credit because accounts that are considered assets are normally debit normal balances, but allowance for doubtful accounts is or carries a credit normal balance. It's listed below, right below accounts receivables as a negative number on the balance sheet. Note that the allowance method follows the matching principle because it will match the revenue generated to the related expense. So I'm going to draw another timeline here to compare the allowance method with the direct write-off method. Just like above, the beginning of the period is January, and shortly after January, there is a sale to a customer named Sean Carter for $30,000. And at a future date, we determined that his account needs to be written off because the customer will not pay. So future date, write off Sean Carter's account. So here, under allowance method, again, the biggest difference between the allowance method and the direct write-off method is you make an estimate right before the period starts. What is that going to require? It's going to require 2 journal entries, actually. So that's another big difference between the direct write-off and the allowance method. The allowance method will require a journal entry right before the period, right before January, and that's on December 31st. It's considered an adjusting entry. We're going to estimate, or the company is going to estimate how much bad debt there will be potentially. So you're going to debit bad debt expense, and let's just assume that they think that they're not going to collect $100,000 worth of accounts. Here, you're going to credit this account where you put the estimate, or you track the estimate of the bad debt, and it's called a allowance for doubtful accounts account. Again, it's an estimate of what is considered to be or possibly accounts that will not be collected. If you notice, the bad debt expense is recorded right away. So now let's fast forward to the future. At a future date, instead of debiting bad debt expense, because we already did before the period started, we are going to debit allowance for doubtful accounts for $30,000. That's the Sean Carter account that can't be collected. And you're going to credit accounts receivables Sean Carter to clear out his account for $30,000. And there it is. If you notice, again, allowance method requires 2 journal entries, one for the estimate, and then the second one for the write-off. And up here, direct write-off method only requires 1 journal entry, and that's when we write off the actual account. If you notice, the bad debt expense is not recorded until later, whereas the allowance method, you record the bad debt expense even before you know which customer will not pay you. In other words, you're recording the bad debt even before you determine which customers will not pay in the future. So there's a difference between the direct write-off method and the allowance method. I made a chart here to illustrate the differences between the two. At the bottom, there's a timeline, start of the year. There's a customer sale on account that happens where the accounts receivable is established. And if we're talking direct write-off, there's only 1 journal entry. It's a debit to bad debt expense and a credit to the AR to write it off. And if we're talking about the allowance method, there's 2 journal entries required. One for the estimate, which is here, where you debit bad debt expense and credit allowance for doubtful accounts. And then finally, in the future, where you debit allowance for doubtful accounts and credit AR or accounts receivable to write the customer's account off. Those are the two differences, and hopefully that picture helps to distinguish between the two. Next, we're going to go over another example so we can contrast the direct write-off method versus the allowance method. Again, these methods are accounting methods to write off uncollectible accounts stemming from accounts receivables or from customers. So here is my example. LMNOP wrote off the following accounts: receivables as uncollectible at the end of 2019. So these are our customers right here: Joe Montana, Jerry Rice, Steve Young, Deion Sanders, and Ricky Waters. All those customers did not pay. Next to them are their open accounts. Journalize the write-offs under the direct write-off method. What is the effect on the net income? All right, remember, this is the direct write-off method. And if you remember from our chart, the direct write-off method only involves one journal entry when you go to write off the account. And that's a debit to bad debt expense and a credit to the accounts receivables to write off the open accounts. And again, this is when the customer account is determined to be uncollectible, whenever that is, or whenever that will be. All right, as I stated, you want to debit bad debt expense. Right now, I'm going to leave that blank because we have multiple customers. So we're going to credit all the accounts receivables for the customer, so we clear out their accounts. First one is accounts receivables, Joe Montana for $3,000. Next customer is accounts receivable, Jerry Rice for $2,500. Accounts receivable, Steve Young for $850. Accounts receivable, Deion Sanders for $35. And one more account, accounts receivable, Ricky Waters for $20. So there, we credited all their accounts receivables. That will clear out their accounts receivable accounts and make them zero. Here, I wanted to combine the journal entry, and if you combined all those credits, it will equal to $6,405. There's an extra question here aside from the journalizing. What is the effect on net income? Remember that on the income statement, it's revenue minus expenses, which will give you your net income. And because bad debt expense is considered an expense, it's going to affect your expense on that income statement. So in reality, when it affects the expense, it's going to lower the net income because you're going to have more expense when you record this entry to write off uncollectible accounts. All right, in comparison, let's do the allowance method. The allowance method, it's the exact same example with the exact same customers and the same amounts that are overdue and that cannot be collected. So what I'm going to do here is I'm going to just copy the journal entry and paste it on the other side since it's the exact same problem. So we're going to do this over here. Let me just copy the journal entry and then I'll paste it on the other side. And there it is. Why am I doing that? Because no matter what, you're still going to write off the accounts receivables and make them zero because you're writing off their accounts and they cannot be collected, and you don't want open accounts if you can't collect on them. The only difference when you write off accounts under allowance method is instead of debiting bad debt expense, you debit allowance for doubtful accounts because previously you already recorded the bad debt at the beginning or before the beginning of the period. So the only thing you're going to change here, or the only difference between the two, is your debit. So you're going to erase the bad debt expense and again, instead debit allowance for doubtful accounts, an account that was set up before the start of the period for potential bad debt from customers. And it's still $6,405. What is the effect on net income for this journal entry? Remember, it's revenue minus expenses equals net income. But there is no effect on net income because if you notice, allowance for doubtful accounts is a contra asset which belongs on the balance sheet. And the accounts receivables listed below that are also assets and are also listed on the balance sheet. And that's why there is no effect on the net income, which is listed on the income statement. So hopefully that helps to contrast between the direct write-off method and the allowance method. One debits the bad debt expense when it's written off, and one debits the allowance for doubtful accounts when accounts are written off. Next, we're going to go over how we estimate when we're using the allowance method. So again, this slide right here just focuses on one method, and that's the allowance method. And the big deal about the allowance method is the company, have to make an estimate on what potentially the uncollectibles are from our customers. So to reiterate, this slide is all about the allowance method, and the allowance method requires an estimate before each period starts on what or possibly what accounts might not be collected, customer accounts. There's two ways of estimating bad debt. One is based on sales, and the other one is based on receivables. Companies will choose one or the other, assuming that they're using the allowance method, and then they'll use one or the other in estimating bad debt. So here's our allowance method right here, and this is where we're estimating the bad debt, and we need some sort of estimate to record that journal entry, the debit to bad debt expense and the credit to allowance for doubtful accounts. Here I have an example. Let's do the based on sales example first. So there it is, based on sales versus based on receivables. We're going to compare the two. It's going to have similar numbers on the examples, so we can make a fair comparison. So let's do the based on sales first. Assume the following: accounts receivables is at $500,000. The allowance for doubtful accounts has a credit balance of $2,000. Estimated sales is at $800,000. And the estimated bad debt is 2% of sales. Usually this is based off industry numbers, depending on what industry a company is in. So we're going to make that journal entry right there. What is the adjusting entry? With all these problems, I like to do a T account first for the allowance for doubtful accounts. So allowance for doubtful accounts, and I'm going to make a T account right here. Remember, the allowance for doubtful accounts usually has a credit normal balance, but it's important to note that the allowance for doubtful accounts can have a starting debit balance. But in this problem, it says that it has a starting credit balance of $2,000 from the previous period. Please note that in the T account, this is where this space right here, this is where the adjusting entry will be. And you'll see in a moment what I mean by that. So there's my T account. There's my existing $2,000 credit. This is based on sales, so it's a really easy calculation. The estimated sales right now is $800,000. Then you're going to multiply by the percentage, which is 2% or 0.02. You will get $16,000. So that amount right there, that is your adjusting entry. Okay, and the adjusting entry goes below the $2,000, so $16,000. If you combine those, our allowance for doubtful accounts now has $18,000 credit because you combined it with the existing $2,000 credit. Now let's do our adjusting entry. Remember, this comes before the start of the period. We're estimating bad debt, so debit bad debt expense, and our amount will be $16,000. You're going to credit allowance for doubtful accounts. We're going to set that account up. Allowance for doubtful accounts for $16,000 as well. And there you have it. That is the adjusting entry to set up bad debt, okay? Be careful because sometimes your starting balance will be on the other side, okay? So your ending balance may not be $18,000. So just be careful if there's any existing debit or credit balances under the allowance for doubtful accounts. And that's why I like to do the T account. Let's illustrate this on the balance sheet. On the balance sheet, that's where your accounts receivables is. And per the problem, you had $500,000 accounts receivables. After making the adjusting journal entry, your allowance for doubtful accounts will be $16,000, and I'm sorry, $18,000. I almost made a mistake there, but it's $18,000. That's the current balance of the allowance for doubtful accounts, and that's why I like to do the T account. See, I almost messed up with the 16,000, but 16,000 is actually your journal entry. So your accounts receivable again was originally $500,000. Your allowance for doubtful accounts originally had 2 and then added another 16 because of the adjusting journal entry. That's 18,000. It's a minus because it's a contra asset account. And now your net realizable value, the difference between accounts receivable and the allowance for doubtful accounts, is 482,000. Now let's do the same problem, but instead of basing it on sales, we're going to base it off receivables. So it's the same. Accounts receivables 500,000. The allowance for doubtful accounts has a credit of $2,000. Estimated sales is 800,000. Here's a new fun fact here. An analysis of receivables shows the allowance for doubtful accounts should be $15,000. What is the adjusting entry? So here we go. Like the previous example, we're going to make an allowance for doubtful accounts T account because it helps you to see what's going on. So again, please take the time to make a T account for the allowance for doubtful accounts. So there's our T account right there. We had an existing balance of $2,000. That existing balance is a credit, so it goes on the right side. I'm going to flip the T account, and remember right here, this is where your adjusting entry will be. And the key thing to notice here is the analysis of receivables shows the allowance for doubtful accounts should be $15,000. So if the problem says anything about estimated sales are $800,000, you don't care about that because this example is based off receivables and not on sales. What you care about is that analysis right there, and it says $15,000. That $15,000 is your ending balance, or should be your ending balance for your allowance for doubtful accounts. So just put $15,000 down there, and then you're almost done. If you had an existing balance of $2,000, and that account should end up with $15,000, well, you need a $13,000 credit to bring that account up to $15,000. So your adjusting entry is the missing piece, which in this case is $13,000. So you're going to debit bad debt expense for $13,000. And then here you're going to credit allowance for doubtful accounts for the same amount, $13,000. Hopefully you get the difference between the two. One, you're multiplying to get the adjusting amount on based off sales. And the other one, you're trying to find out what your ending balance should be, which in this case is $15,000 for allowance for doubtful accounts. And then doing a little bit of algebra because there is a variable there, and the variable is $13,000 to get up to the $15,000 final balance. Let's reflect all this on the balance sheet. Remember, we had accounts receivables. Below that is your contra asset, which is allowance for doubtful accounts. And the difference between the two is called net realizable value. That's not an account, but just a line item that shows the difference between the two accounts above, which is the accounts receivable at $500,000. And then your allowance for doubtful accounts should have a final balance of $15,000. That's a negative because allowance for doubtful accounts is a contra asset, and the difference between the two is $485,000. That is your net realizable value for that example there. Again, take the time to draw out a T account when you are doing the allowance method